Okay, we're going to talk about how to invest well next. And as a disclaimer, I'm not a financial advisor. This is not financial advice. This is all just general information for education, entertainment. You should talk to a professional if you want to get deep into your individual situation. So, investing is really the engine of the wealth creation that happens. Everything we've been talking about to now about increasing your income, about maximizing or minimizing your taxes, that's really to save money so you can actually invest it. And there's a lot of options. It can be very confusing, and choosing what to invest your money in is really the hardest decision in this whole thing. For most people, I think that investing in a low-cost diversified stock ETF is the best option. And that is especially true for younger people who have more time on their side in case there is a drop. Okay, so I'm going to break this down into sort of like two sides of things for investing. One is when and how to buy something and what to buy. And then the other side is going to be about selling. So let's start with buying. What are all the different options for investing? You kind of have first a bunch of bank accounts that are insured by the FDIC. These are checking accounts, savings accounts, CDs, and these are kind of guaranteed, essentially, right? You know what interest you're going to get. That might change over time, but generally you have a specific number and they're going to give you that unless the bank fails, right? Which is very uncommon. So that's generally a pretty low rate, although recently savings and CDs have been higher, closer to 4%, because inflation has increased. And so that's kind of your base case, that's the safest sort of that you can really go. And then you've got kind of stocks and equities, which are kind of the same. They're two names for the same thing. There's a few different types. There's individual stocks. There's mutual funds, which are a collection of stocks. And there are also exchange traded funds, which are another different kind of vehicle for stocks of individual companies. That's generally going to have higher returns on average, and so they're more attractive in that sense, but they also have more volatility. They can go up and down, so it's kind of unattractive in that sense. With bonds, or also known as fixed income, you can buy individual bonds, where basically someone is saying, I will promise to pay you a certain amount of money in a certain amount of time. And then you've got government bonds, which are when the government is borrowing from you or you're lending money to the government. There's municipal bonds for lending money to cities. There's corporate bonds for lending money to companies. And then there are bond funds, which are collections of these different types of bonds. There's all kinds of bond funds, and it could be one, for example, that has a collection of different municipal bonds from different areas so that you don't have to go and buy individual bonds. You can just buy a bond fund that has a bunch of them that are kind of gives you that diversification, so you're not putting all of your eggs in one basket. And then there's also kind of money market funds, and these are kind of places where generally people put cash that they're planning to invest, but want to hold it in something that will give them some kind of return. Like, for example, if they just put it in a checking account, most checking accounts won't give you any or very much money at all. So these are generally better. They tend to be somewhere in the sort of like 4% range, and kind of similar to CDs and also government bonds, because a lot of the times these bond funds are actually invested in the government bonds themselves. There's a couple of distinctions that are interesting here. Generally, the government bonds for the U.S. government are you don't have to pay state taxes on them. And then for the municipal bonds, I think you don't have to pay income taxes for the federal and the state level. So that's why their rates tend to be lower, more like 3% or less than some of these other types of bonds. Okay, and then there's real estate. You can buy homes, you can buy land, you can buy apartments and things like that. So these are all things that are pretty well known to people, kind of obvious, what you're getting and what you're not. And so in general, stocks have had the highest annual returns on average. And next would be kind of bonds, and then your kind of bank accounts tend to be less than that. Real estate is very dependent on where it is, and so also has kind of high variation. It just depends on what area, what kind of property it is, and so on. They tend to be close to 5% if you were to try to sort of rank things, because a lot of the deals that are done kind of have that sort of as the sort of assumed rate for the rate of return. Aside from those ones, there's quite a few other options for investing that are, I would say, more complex or more advanced. So, for example, like an annuity is a contract where you're basically giving a company a lot of money up front or earlier, and then they will agree to pay you a certain amount of money for the rest of your life, usually. So it's kind of, you have to decide whether that's worth it or not. There's oftentimes a lot of fees involved, and what they give you as a proportion of what money you put in can often be lower than what the market can give you. So that's one reason why I haven't looked too much into this area. There's options, which are you're buying a contract to be able to buy or sell a stock at a future date. And so you can also sell the obligation or the option to buy or sell a stock at a future date as well. But these are quite complicated, and one might use it if you're thinking that a certain stock will go up in price a lot, and so then you might buy an option to sell a stock at a certain price, and you might buy it when it's much the price that you can buy the stock at is actually much higher. And so when that's the case, you're not paying very much money for it because it's not really worth anything at that point. But let's say you buy that option, and then after earnings or after some event, that price of the stock actually goes up by a lot, then you can exercise the option to buy at the price that you had set earlier, and then sell it at the current price, which, if it's higher than what you had for the strike price of the option, then you will be able to make money off of that. There's also things called futures, which is when you say at a certain date that you will buy or sell, I guess, a certain thing, could be a stock, could be a commodity, at a certain price. So that is not an option because you say that you will definitely do it. That's kind of the difference. You can trade commodities. So these things might be oil, it could be orange juice, it could be, generally I think they're futures for them. You can also trade the actual goods, which is useful if you're maybe like a farmer or someone who actually uses that stuff. There's generally the term derivatives is used for some of these options and futures that are kind of based on contracts that trade as underlying stock or some other kind of security. There's foreign exchange, so that's when you're trading currencies. So it might be that you're buying euros with dollars, and you're kind of betting that euros will go appreciate in value for some reason, or the opposite. Private equity is when a lot of times they're buying companies with private money, and they're running it for a little bit. Maybe they think there's an opportunity to improve this business. It's often run by management consultants, and so then they prove the business, and maybe after 3 or 5 years, they go and sell the business for more money, or they offer it to the public in an IPO. And then venture capital is generally when you have kind of smaller companies that need money to grow, and so they get a bunch of money from venture capitalists, and this small business grows up to be a very big business. And then once that happens, the venture capitalists can sell the shares that they have in these private companies, and make a lot of money from that, like very rapid appreciation in the value of the equity. And then you can also collect art and collectibles. So art, could be like famous art, or collectibles could be things like baseball cards or like Pokemon cards and stuff like that. Okay, so generally the main decision that people make in investing is stocks or bonds. And so stocks are shares or fractional ownership of companies. So you're buying a part of a company. And the way to get money from owning stocks is really when the price of the stock goes up, and then you sell your share of that company. And the other way is when the company gives you a dividend, which are part of their profits, because you own a share of that stock, or a share of that company, or a stock of the company. So yeah, generally stocks benefit from increases in productivity, and over the last century or so, they've gone up by 10% each year on a nominal basis. So if you're holding these stocks generally for more than a year, you're going to pay a long-term capital gains rate, which is usually 15 or 20%. And so from that 10%, you might get an 8.5% or an 8% return after your taxes. The only problem, the reason why not everyone just buys only stocks, is because they can go down in value, which is like a really negative feeling. I think recently, I'm recording this around the time of the tariff announcements, and we've seen that the stock market has lost about 10% in 2 days. And so when that happens, people get kind of nervous. You might not stick to the strategy very well. It's kind of hard to stay invested when something like that happens. And yeah, you need to have diversification in what you've bought. You need to look at how to diversify the cost of what you bought using something like dollar cost averaging. And you need to think really in a long-term sort of way so that you can weather all of these downturns when they happen, when the stocks do go down in value. So that's kind of owning what a stock is, essentially. Now, bonds are much simpler in that they promise to pay you a fixed amount over time, and also at the end of a certain fixed amount of time. So they are giving you interest, which is taxed at ordinary rates usually. So this is for, say, corporate bonds is the main kind of one there. There are other types of bonds which are tax advantaged. So I think I mentioned this before. Municipal and treasury bonds, they are tax exempt from certain state and federal income taxes. So depending on the type that you have, the returns will be lower as a result of that. And then stocks are generally have a higher potential for earnings versus bonds. But bonds are less risky. They kind of, unless the thing, the entity or that you're lending the money to is going out of business, then you're gonna get the amount that they told you you were gonna get. And also, if, for example, a company does go out of business, then the money that the company has will first go to the bondholders to pay them back. And then whatever is left, if there's anything left, will go to the stockholders. So you kind of have preferred treatment in the capital structure, which is why bonds are generally a bit safer and also why they are lower in return. In our situation where we're looking at mostly saving for retirement or building a lot of wealth, the stocks really make a lot more sense just because they are going to have the highest rates of return that you're going to get over time. And because retirement is generally in a long time, in 30 or 40 years, that means that you kind of have the amount of time for the stocks to appreciate quite a lot. So if you're buying stocks, should you be buying an index fund or should you be picking individual stocks? Okay, so what is an index fund? An index tries to give you like a single number to gauge how a group of companies are doing. So these indices are created by companies. So the S&P 500, which is the most famous US index, is made by Standard & Poor's, which is a company. That's what the S&P stands for. While you can't directly invest in the S&P 500 index, there are companies that make mutual funds or ETFs that essentially mirror or track that index, and they're called index funds. So how do you know like which S&P 500 stock is the next big winner? So recently NVIDIA has gone up a lot, and then in the last few months it's gone down also quite a bit. But during the last 5 years, it's still gone up by some crazy number, like 1,000% or something like that. So it's really hard to actually see these stocks ahead of time. And so what do? You can just buy them all, essentially. And that's basically what you're doing when you buy an index fund. Yeah. So picking stocks is actually very hard, and it requires a lot of time. Most people are not professionals in this. And if you, even if you spend the time, like the performance a lot of times for actively managed funds is going to be whatever the S&P 500 index is minus the cost of the fees that the fund managers are charging you, because most fund managers are not going to be able to outperform the S&P 500. And if you're trying to do it yourself, it just takes a lot of time. It's very hard to do this when you're actually doing your job as well. So you're basically, when you're buying a stock index fund, you're essentially just kind of getting an average result, and you're buying a lot of different companies at the same time. Yep. So my experience actually buying stocks, I started, there's been a few times when I've done this. Started with $400,000. It actually did very well because I had bought Amazon and Nvidia and Tesla back in 2017 or 2018, around that time. They did very well. And then, I had so it's possible to actually outperform if you just manage to pick the right things and manage to hold them. Like, unfortunately, with a couple of these, they had gone up by so much that it seemed preposterous that they would continue to go up by more. So this was Tesla and Nvidia. And so I kind of sold before they got to appreciate by as much as they did. At another time, I had like a lot of Meta stock because I've worked there for a while. And so basically, at one point I had so much that I was like, I need to kind of like diversify this Meta stock into other tech companies so that I don't just all have so much money in one basket. That's actually done pretty well over the last 5 years, despite the recent kind of drop of 10%. But again, like, I think this is sort of just luck that's happening. It's hard to say that the ability to pick that has been my ability purely. And so sometimes you're just better to be lucky than good. And I think the problem sometimes is that if you do get lucky, you might think that you're actually good at something. So I thought I was actually pretty decent at this, and then I bought some more stocks and with like about $40,000. This did terribly because that particular period, I bought some banks and airlines around 2022, and they were doing terribly. Everything was doing terribly that year. And recently, I think last year, I was looking at basically doing a bit of trading with about $30,000 and just seeing like how would I do against the S&P 500. That didn't turn out so well. Didn't beat it, and also found out that like it just takes a lot of time to do this sort of stuff. So even if you do end up doing better than the S&P 500, it's kind of a lot of luck sometimes, and based on the timing of things. There's a lot of things you just don't know about that can happen, and things can happen really out of the blue that it's just hard to know what to do at each point if you own individual stocks, if you aren't really paying attention all of the time. So if you're buying an index fund, which index funds should you buy? There's actually a lot of different options now. And so there's large cap or capitalization funds, there's mid cap, there's small cap, there's US and international. And that's based on kind of where the company is registered. There's different strategies for funds where you have what are called growth stocks, which are ones that have higher revenue growth, and generally they're like younger companies, and but people tend to pay more for those, so they're more expensive. And there's also what are called value funds or strategies where the companies are less expensive, but they don't tend to grow as much, and so there's kind of like a balance of those things. There's really like pros and cons for each of these types. The large cap, the biggest companies by market capitalization, that's essentially just the price of the stock times how many shares there are of the stock. That's kind of what the market thinks that the companies are valued at any particular time. The small caps are just like smaller companies. They might be like about $1 billion worth. And U.S. companies, while they might be based in the U.S., they kind of do business all around the world. So their revenues are kind of across the world. International companies, they're often broken down into ones that are listed in developed countries, quote unquote, and developing countries. So that's another kind of way to look at different funds or index funds, which might give you exposure to each of these sets of countries. So my experience with like index funds, like really recently, I was looking like last year, I was looking at the investments that I made into some of the robo advisors, like Betterment and Wealthfront, and I made these investments about 10 years ago, and they're generally diversified across the whole world. Calculated what they did over the last 10 years, and international stocks, those ones outside of the US, have really underperformed by quite a lot. The developed market ones have underperformed by 68%. I wrote this back about a year ago, so like around this time in 2024. And the ones for the developing markets had underperformed then by about 92%. So based on that last year, I moved some of my money, or a lot of my investments, out from the international stocks and towards the US. So it's actually kind of interesting now with the recent changes of tariffs and having the US stocks drop by so much, whether this is still a good strategy, but I think this is a wait and see sort of situation. So like now we've kind of like figured out like what to actually buy. When do you actually buy it? And is this currently a bad time to do that? Right. So timing is like one of the biggest challenges. And I think, you can kind of, you're not going to get it right every time is the thing. So one kind of strategy to get around or to deal with this problem is to basically say that I'm going to invest a certain amount of money at a certain period of time, each period of time, and that's called dollar cost averaging, which is the same dollar amount, and the cost is averaged for all the different times in which I've put in money over these like regular periods, because you expect that the cost will be different during each of these periods. That basically gives you some diversification in time and timing, so you don't have to be super precise in terms of worrying about it, because you kind of have to think about like, okay, do I expect that the stock prices will be higher 10 years from now, or like 30 years from now when I'm planning to retire? So that's really that long-term vision that you need to have when you're thinking about buying stocks. And I'm kind of willing to bet that's these stock prices will be higher then. So I'm less concerned about right now, and kind of willing to put in some amount each regular period. Yeah. So generally, if you're young, you actually don't want the prices to be too high before you have enough money to buy a significant amount of stocks. So the fact that the market has dropped 10% in the last few days, that's actually kind of like a sale. So like back a year ago, towards the end of 2023, the market had gone up something like 20 something percent, 24% maybe, and at that point I think people were thinking that the market was already too high. But at that point I was thinking, well, I'm still I had a lot of cash just sitting there for a while, so I was like, I think I should still put this money into the market and buy the stocks. And so I kind of used dollar cost averaging to really as a tool, like a psychological tool, to kind of give me the confidence to do that, because you kind of just don't want to be regretting your decisions really. So like if I thought that everything was just going to go up and that was it, then I would have probably just put all of it in at once. But I'm like trying to minimize the amount of regret that I have if things do go down, because let's say that you started putting in money last week, or maybe not last, like 2 weeks ago, let's say, and then the market dropped by 10%. You can, because you're still working, you actually are just kind of getting things on sale for a bit, and so like you could maybe buy next week, and then if you're doing the every 2 weeks thing, and buying every 2 weeks, so you're actually just going to get more. You're going to get basically 10% more than you did like the first time. And let's say that they went down by another 10%, like now you can again buy another bit, and the price will have gone down another 10%. So like you're just going to get more than you would have gotten if the price had actually stayed the same or had gone up. So in some cases, when the market is down temporarily, which is generally the case, like it's going to go down, but it's recovered in the amount of the last century or so of history that we have, after some time. So as long as you don't like need that money right away, then actually buying it when it's gone down is actually a good idea. Okay, so should you buy a house or should you rent? I think that buying a house is a good investment if the cost of buying a house is lower than the cost of renting. And there's some things that can sort of help you with that, because there's tax advantages for buying a home. In the US, we have these 30-year fixed rate mortgages. They're actually quite uncommon outside of the US, because they are subsidized by the US government. And so that's kind of a nice thing, that you can kind of get such a generous loan. Like all the people that got 3% loans are probably pretty happy right now because the interest rates are so much higher now. There's also specific tax deductions for mortgages and property tax. And you actually don't have to pay capital gains tax for up to $250,000 of gains if you're single, or $500,000 if you're married, filing jointly. And so there's definitely advantages that are baked into the tax code to encourage people to buy homes. The problem is that because of some of these advantages, the homes are quite expensive in some of the areas that are where the tech hubs are, essentially. So New York, San Francisco, the homes are generally over $1 million or more. So there's that, and then closing costs on homes when you finish buying a home, they can be somewhere like tens of thousands of dollars, and so you kind of have to keep the home for a bit before you sell it. Otherwise, you're paying that cost over a much shorter period of time, and you're not able to spread it out over time. And then also homes kind of reduce your ability to move. You're going to have to find like renters and stuff. Whereas if you just rent a home, then you can kind of just move the next available time. And so it's not as complicated to just find a sublease or something instead of having someone buy your home from you. And because I live in New York, I think about New York housing a lot, and my point of view, it's just too expensive, because a lot of the home prices don't actually justify the rents that they can generate. So any like kind of decent 2-bedroom is going to be kind of around $900,000 or $1 million, if you or more. And if you kind of go somewhere else, then for example, my friend lives in Louisville, Kentucky, where the median home price is somewhere closer to $200,000. It's much easier to justify that. I would say that in some of these high cost situations, the other reason or a main reason why you might want to buy a home over renting is, for example, if you want your children to like live in the same school district for the whole time that they're in school. And a lot of these decisions around buying homes are essentially like a consumption decision. You've decided that you want a home and that's what you want to spend your money on. And if you can afford it, I think that's totally fine. So now I'm going to talk about sort of the selling side of things and how to sell. Okay, so should you buy and hold or buy and sell when the prices go up and down? So generally, buying and holding is a lot more tax efficient, and it's really quite hard to time the market so that you're buying when it's high and selling when it's low. It's actually kind of more common to see something having gone up and then bought it than thinking that the trend will continue. So yeah, and then to sell something after it's gone down a lot. So you're kind of, your natural instincts is to follow the momentum of where the market is going and to buy when it's high and sell when it's too low. So it's very difficult to make these decisions. It's kind of the reason why like managing money actively is a person's job, because they have to watch the market constantly. So yeah, like an example here would be, at the end of 2023, the market had gone up something like 25%. So you're thinking like, well, actually that's really great. Like, is that too high? Do I need to sell now? And if you had sold then you would have missed the 2024 gains of about 25% again. And then who would have known that was going to happen? It's really tricky, because let's say you had sold at the end of 2023 and now you're waiting for a good opportunity to buy back in, but it's just gone up the whole time. So like you're going to have to then buy back at a higher price than what you had sold at. So you would have lost some money there. So that's really difficult, and you can't necessarily wait because now we're in a situation where the market's lost like 10% in a couple of days and maybe 15 over a few months. And so it's just like, okay, well, what's going to happen now? Like, is it going to go down another 20%? If it does, then it would have made the decision for you to sell at the end of 2023 like a really good decision, because you had predicted that, and that would have been a difference. But a lot of times people don't stick with that. They probably would have bought back when they saw that the stocks were continuing to go up, and so it's really quite challenging to make these decisions. Yeah. Again, that's why people are paid to do this, and it's unclear whether they can do it well either. So it's really challenging in general. In terms of the tax treatment, you generally want to sell the losses and keep the gains. That's because the losses are actually tax deductible against your income. And so that can help you. Now, if you don't sell the gains, then you're actually not taxed until you do sell them. So when you sell them, then you're kind of losing some money due to taxes at that point. And there are certain things you can do with gains, unrealized gains, like donating to charity, that can kind of save you money, because you don't have to, you get the value of the gains as a tax deduction from the charity, but then you don't need to pay the long-term capital gains tax on those gains because you're giving it to charity. So how do you deal with unrealized losses? So I think right now is a pretty good example of what's happened. You're basically, I've been watching how like the market's gone down about 10%. And so at this point, you know, you haven't actually lost any money yet because you need to actually sell the stock at the lower price in order to realize that loss. And if we were to look back at March of 2020 during the COVID pandemic, then it did actually drop quite a lot, and then kind of came right back. And so sometimes the best thing is actually to not do anything. So yeah, but if it does go down and you can actually lose, you can use a tax strategy called tax loss harvesting, where essentially, you're selling a stock for less than what you bought it for. You have a capital loss. It can actually cancel out some of the gains that you have from other things, and so you can kind of use that loss to reduce your income, which is very useful. There's things around what is called a wash rule, where you buying and selling the same stock within 30 days that you have to watch out for, but I'm not going to go into detail there. And then if you basically have more losses in a certain year than you do in gains, you can actually take 3,000 of that loss and cancel out some of your W-2 income from your job, which is also kind of useful, given that many of us are going to be taxed at fairly high rates. And then if you have any kind of unused capital gains, it can be carried over to the next year, which is pretty useful. And you can use those losses the next year. So for example, I had a loss in 2023 of about 7,000, kind of sold some gains in 2024 to use up some of that loss and kind of increase my cost basis for some of my stocks. And so kind of use that as an opportunity to sell some losers and switch some of my stocks from international to US. And then what happens, how do you deal with gains, unrealized gains, right? So let's say that you have a gain of $100 that's unrealized. If you sell it, it becomes realized. And kind of a big advantage of capital gains is that you can choose when to make that income, unlike income from work, from jobs, which is W-2 income. So for someone who's making about $200,000, if you're selling now that $100 in gain, you have to pay ordinary income taxes. That's about 35%. If you sell after a year of holding that stock, then the gains, you're only going to pay about 26% because you're kind of saving on the federal rate there. If you never sell and you pass it on to your heirs, you actually don't pay anything in gains because of what's called the step-up basis rule. And if you give the shares to charity, like I kind of mentioned before, you get a deduction on your income. So it's like negative income, which is a benefit. And then also you don't pay any capital gains tax either on the gains there. And then the other thing to know is that let's say that you were to retire early, or you decide that you're going to take a gap year or something like that to take a break, then in certain low income years, you can actually sell stock up to a certain number. And if your income is below a certain number, then you actually pay 0% in capital gains. So that's kind of what I meant before about how like choosing when you're selling is actually a very useful thing to be able to do, because you don't want to necessarily take gains during high income years. You want to take them during low income years, which especially will happen when you're retired as well. So when do you actually sell in a buy and hold strategy? You sell when you need money, right? The other reasons are that you can sell when you want to have some losses that to balance out some gains. You might want to sell when you're trying to change the composition of your portfolio as you're getting closer to retirement, so that it has more bonds in it, for example. Or, like I said before, you could take gains during a low income year and pay 0% in taxes, in capital gains tax then. Because with that last one, you can actually just buy back the same stock. And basically, you can increase the cost basis of the stock that you just own there. So that in the future, if you sell it again, then your basis is now the higher number. The other thing that's kind of useful for people, for software engineers, is that you might get stock in your company. And so this kind of depends on how much you believe in the company's value. And if you were to ask yourself, like, if I had gotten this much money in cash, would I use it to buy the company stock or not? And if not, then maybe you should consider selling the company stock that you're getting kind of as income. Because the reason why it matters that it's an RSU is that the value of it changes while it's not vested. And so that's the kind of part where you're gaining from the value of the company increasing. And so at the point at which it's given to you, it's basically cash that's given to you. And so you should think of it as cash in that way. And then in terms of actually like managing the investments themselves, what do you need to do? So there's kind of like a few things that I look at. Usually I look at tax loss harvesting. Like each December, I'm going to look at my different stocks and see are there ones where it's gone down and I don't really want to own this anymore, and I want to sell it at a loss so I can offset some gains elsewhere. I might want to sell something that's been underperforming a lot. And then I also want to check to see if I have too much money in one stock or one industry. That's something that happens more like on a monthly basis for me. And then I'm looking at kind of how much cash do I have, and is that too much or not enough? And I might look to see, like, are there future cash needs that I need soon, so that I have to think about, I need to build up some cash for that purpose. It could be like a down payment for a house, for example. You might want to be selling some stock to get enough money for that. And the other question that comes up a lot is, should you be giving your money to someone to invest for you? And I think the answer is probably not, because there's been some studies done where they've tracked like different fund managers and how well they've performed against the S&P 500 over a 10 years period, and it's like less than 50% of them are able to outperform. And generally, because they charge you so much in fees, a lot of the times your return is basically what the S&P 500 is minus the fees that they charge. So it's kind of not really worth it. When people are managing your money, the hardest thing is the asset allocation. Once they've chosen that, then like what work are they actually still doing after that point, right? Like, they're just charging you 1% for really no reason at all. So if you want to get if you don't know what you're doing and you want to get more specific advice besides just buying index funds, for example, then you should be looking at getting some sort of financial advisor that is a fiduciary. And basically that means someone who is going to be acting in your best interest and paying them like a flat fee or a month, like an hourly fee for the help that they're giving you. If they're not a fiduciary, a lot of times those people are actually salespeople. And so they're basically giving you advice to buy something that they're getting a commission off of because you bought it. And so it kind of creates this conflict of interest situation where they want you to buy it because they can get money from selling that product. And it's not really in your best interest. Yeah. So hopefully I've kind of shown you that buying a low cost diversified portfolio of stocks is not that hard and is fairly easy to maintain by yourself, that you don't actually need to have someone else do that for you. Okay, and the last topic that we have is really around kind of what is all this money for, and kind of what different levels of wealth are.